Hello, 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 my Goonies. I called the rest of the officers and also Forrester a Goonie. So just want to be inclusive, because I'm that kind of guy. I'm nice like that. You're welcome. All right. So we're gonna go ahead and give a quick market update here after quickly asking if anyone has any questions or points they would like to bring up.
So what's a trust fund?
What's a trust fund?
Yes.
So you've heard the phrase like a trust fund baby, right?
Yes.
Yeah. So it's what very, very wealthy people do with their money when they pass away and they want to give it to like their child, but like maybe their child isn't like old enough yet or that sort of thing. It's part of the will. Maybe it's their grandchild. Doesn't really matter. They put it into something you could say like probably along the lines very closely related to like a mutual fund. Okay. And there's certain part of the tax code because of the way that they have it sorted through, like when they die, because there's the death tax as it's called, or the estate tax, which is what it was originally called, and they changed the name because they wanted to trick poor people like us to be like, no. Anyways, yeah, Congress. So it's just a tax advantage way of being like, hey, you know what? I'm gonna put my money into this this fund over here. It's gonna be managed when they get old enough. Bam, they have access to it, that sort of thing. I wouldn't be an expert in those sort of concerns to speak so in depth about that, but hey, call the IRS. You can literally do that, and just ask some questions. But that's my basic understanding of them. Yes, Ryder, you had
to extend on a trust fund. It's basically a management of assets on somebody else's behalf.
Yep.
So you if you had a trust fund for somebody else, you would have full control over the assets while somebody else receives the assets, and completely dependent on your terms.
Okay.
And depending on how you set it up, you can set it up to where it's like irrevocable, and it will no matter what go to them, or it can be revocable, meaning you can do whatever you want, but take the trust fund away if you have to, or change the terms of how it's set.
Do I have to be wealthy?
No.
Okay. No, I don't see why you would have to technically be wealthy. It's just a thing that wealthy people do.
My parents have set one up. The key aspect of a trust fund that's important is the fact that it follows a step-up basis. Step-up basis is where basically you can transfer your assets to somebody else, which is essentially, in a way, the transaction is a sale and then a repurchase. But you can do it without paying any taxes on those capital gains through a thing called the step-up basis. They tried to get rid of it they were kind of talking about getting rid of it, but they didn't. Because basically it's like when any rich person dies, they can just transmit all of their estate to their kids and the taxpayer doesn't see a dime of that. So that's the real benefit.
So that exists or it doesn't exist?
It would.
That does exist?
That does exist. You still have the step-up basis where you won't be taxed on that transfer. Okay. So that's the real key aspect of it, is step-up basis more than anything else.
So that's kind of a question. If there's no capital gains, why can't I set up a trust fund for myself?
I believe it has to be in a different person's name, but...
Okay. Yeah, I mean, again, how exactly that's going to work, something to explore. Get in contact with the IRS, they will literally know. Or, hey, there's organizations out there that will help you. I've done this myself. I've literally just asked tax organizations that help you go through your taxes for free, and I've just asked some questions. There is an organization out there, I can't remember the name of them, but I can figure that out next time you want. But I mean, you can just look up online too, organizations out there, because they're a real thing to help you go through your taxes and just ask some fucking questions. So you have resources out there. You want to figure out how exactly does that work. I just know the very surface level of that sort of particular topic. But hey, certainly if you want to research that and maybe contribute that to the conversation, please do. We're always wanting and help, for collecting together information perspectives that we ourselves are limited in getting because we're only a human. You know what I mean? So that sort of thing. So yeah, go for it, man. Explore.
Yeah. Something else I wanted to preface the group with. So I'm with the Student Athlete Advisory Committee.
Cool.
Because I used to be a student athlete here, whatever. And we're starting this fundraiser, and there's a lot of work, pieces financially that are working in the background. And I was wondering if you wanted to help out, you could. I walk into banks. This is what we got going on. How can you help us?
If you need help doing the fundraiser, let me know. We ran one last year very successfully, so I can help you with that.
That's right. Yeah, Forrest is your guy. He's the guy. Yeah.
Yeah, I feel very serious with that. Especially doing it in person. If you want to do an in-person event as a fundraiser, I know how to get all the licenses and all that signed away, or permitting signed away.
Okay. So if no one else has anything pressing, let's go ahead and continue on. Shouting out here, if you guys find anything that is meaningful, part of the experiences of the investment club, please reach out to your friends because they are also poor as fuck. So, that sort of thing. Also, shout out for 3 really good charities: Charity Water, World Central Kitchen, and Austin Pets Alive. They are amazing. So if you make any money from this, please do consider contributing back to the community as well, because this is all free. And as the adage goes that I created, the world is better when we care together.
Do you want to donate to my charity?
No.
It's a real thing.
No, I believe it, but I'm not doing it. I'm taking my money for other causes.
Club.
Sorry. Huh?
Keep the money within the investment club. Small circle.
Yeah.
All right. Here's an icebreaker, because we wanted to do this. Let's see. Let me try to pick one. What are people's current understanding of the situation concerning student loan forgiveness? Are people up to date on that? Is kind of really the question I want to ask. Are people up to date on that, or are there people being like, I don't know what's going on? Ryder, you don't know what's going on?
I have questions about it.
Okay.
I'm completely up to date on it.
Okay, all right. Ryder, go ahead and shoot out a question there.
Well, this is my first semester here. I paid for my first semester out of pocket. I'm wondering if I can take a loan out for my other semesters and get it forgiven.
Only
Sure.
government. Were you offered loans by the government?
Yes.
Take those. You need to be very careful about that because I believe that there is a cutoff date. I want to say that you might be able to do it next semester, but the cutoff date comes up very quickly. So it's not for new debt; it's old debt.
Yeah, I thought the cutoff date was last year's debt.
It might have
I
been.
think applies
It might have been
to
what you accepted for this year
Yeah.
going in. I believe it was like basically when they announced it. So it wouldn't make sense to take out a new loan.
Exactly. So that's kind of the thing.
Yeah.
I would need to know where the cutoff date is, and if it is last year.
It's
then
on the.
probably-
It's in the.
Yeah,
It's
right.
on their webpage
Yeah.
too. You can find the exact date.
I also don't see them doing this again, to be totally honest
No,
with
they
you.
don't.
So,
They're
like,
gonna do this
There's a
again.
big
don't
question
bank on it.
on if they're even going to be able to do it right now. They're not dispersing any money because they are in a federal lawsuit with multiple states.
Definitely don't take out a loan.
Yeah,
Take
don't
out
take
a
out-
loan.
don't take out a loan.
But if they were going to guarantee it, or yes,
Yeah.
you
Then
can do
yes.
it next
You
semester.
definitely can.
I would be doing it.
You
100%.
definitely can.
But I haven't heard everybody in my
Yeah.
situation talking about this, so
Yeah, it's for
knowing that
past
is
debt.
probably not the case.
Isn't it only forgiveness to a certain dollar amount?
Yeah, 10,000 unless you have a Pell Grant,
20.
which is 20.
That's what. Okay, that's
Yep.
what I was thinking.
All right, we're gonna have a quick market update here. By the way, also shout out. I said the wrong. I don't even know how it happened because I know this. Forrest, last time you asked if Wix could count as closing the gap. They do. I think for some weird reason I said they don't. They do. I knew that too. Wix can definitely count as closing the gap. So that is a thing.
Okay, gotcha.
Rehashing for people who are like, what? So a gap would be see that right there? That's a gap between both the bodies and the wicks, as we say here. If I can try to zoom up on here on a really obvious
So
wick.
in a sense, you can kind of view the wick as being a less strong sort of indicator, and then the body is the strong indicator, and so it would have almost strong gap versus weak gap.
It depends on what the context is. For gaps, no, they're going to be the
they are.
same thing. Yeah, this is a wick. So you see, there's this thick part, and there's a little skinny line right there. In there too. Those are wicks. They're also called shadows. Anyways, so like I said before, there is a gap here that's really obvious up above. I'm also thinking that it's funny. We're going to look at cycle analysis here. If I can here, never mind. Here, this gap right here. These are, think of a power vacuum. There's a classic trait of when very obvious gaps like that happen that they get filled. Now it doesn't have to be. It's usually near term. In the near term, next few months or something like that. But not always the case. Sometimes it can be literal years later. But that is pretty rare. But just saying though, here's a really obvious gap right there, and it can be filled by a wick or a body, as we would say, the thick part. And right here, if you drag that across, is in this area. Now I talked about Fibonacci lines before. This is Fibonacci retracements. Don't worry about them so much. Maybe this is another time we'll go into. I think I already covered it a while ago, but we can go into it later on. It's just a technical analysis tool. That's kind of really it. Anyways, though, so it helps defining lines of that are significant areas of support and or resistance. So here we have a Fibonacci retracement set up as we are in a bear market. We're looking at where it can retrace upwards, where it can go back on itself against the general trend here. That's what retracement in that context functions as. Anyways, so this area, just very funny, this very obvious gap right there, lines up very closely with this line up here of technical analysis. If I can zoom out here, you guys can see it. You see the trend here, right? Upper range, bottom range, right? So just so happens very closely to both doubling up on the Fibonacci. It's just like kind of fucking funny like this. So this Fibonacci retracement comes from the current downfall that we've been seeing, and then the one before it comes from the larger COVID stock market bubble bull run. Anyways. So it's just sort of funny. It's just a pretty significant area. It lines up there, and as well with that, and also cycle analysis bets that as well. So if I had to put my money anywhere, up about here is probably where we're going to stop, and then we're going to continue crashing. Okay, so there's that, and also cycle analysis. I keep talking about it. What the heck is it about? We're going to go ahead and listen to this guy.
This cycle.
Okay, cool. All right, we're just going to go ahead and listen to this guy, and this is Steve Miller. His name is Steve Miller. This is like, honestly, from what I've seen, he's like one of the leaders in cycle analysis. This guy knows his stuff. He's been doing it for 40 years. He was on the Chicago Board of Exchange. So he's pretty damn accurate. He's probably one of the better traders I think I've ever seen. I've seen a lot. So he's going to go over how cycle analysis works, and he's going to talk about what we can expect in the near term. Forrest, do you have a quick question?
Does he ever give out prices?
Yes. Yeah, he has areas. He won't. The way that he operates, which is the smarter way to go about it, is that he won't say like, this is exactly going to happen. This is definitely, he doesn't do that sort of thing. What he'll say is that this is a significant line that would make sense given the evidence that we've gotten so far.
He's telling you like jump in, jump out though. Sort of my question is, he giving you anything direct advice?
No, I don't think he engages in that sort of rhetoric, and I would think that's a good thing. I would say that's not like I mean, he swing trades, and there's help that he can offer if you're willing to pay for it. But he won't, like, in general terms, be like, all right, guys, now's the time to, he would just do that sort of thing, which is honestly probably like a better idea. Anyways, though, all right, so we're going to go ahead and listen to him and see what he says about how this works.
Which made a higher high, formed a left shoulder and a head. And as this rally came right over here and it failed early, that's what's called a left-hand translation, it set up the decline all the way to the bottom of this cycle right over here, which ran about 3 weeks long, and that is well within the principle of variation, normal variations in length. You can see it failed in resistance here, failed in resistance here, failed in resistance here, all of those. And these yellow ovals are where 2 cycles were coming down, giving you the biggest downside risk. And that is out over here, again coming in sometime mid-January through sometime late March or April, where it is expected that the market will have a very sizable decline. This bigger cycle right over here is a 36-week more dominant cycle, and that comes down into that same time frame also. This period here will have 3 cycles moving to the downside. That's all energy of liquidation during that period, and that is set up to give the market a very sizable decline during that period. So you can see that each of these cycles got to a lower low. This one had the market from its peak down 14.4%. This one in the mid-cycle, 24.4. This one, 27.4 on the S&P 500. And we're projecting a 30 to 35% loss in this bear market sometime out in this late winter or early spring period for the market. But where are we now? That's an important question. Let's just look at these cycles right over here. And we had talked about the bottoming coming and the potential for a market rally. Whoops, sorry about that. Out into the fourth quarter. And that is what we are getting now. This rally that we have is getting up to the first resistance levels right there. We thought it could get up to near this level right here at that major 38%. That's about 391. There's a minor resistance here at about 390. So you can see 390, 391 is the beginning of this resistance area. Now, we would expect that it would easily get up here, and this is the bigger cycle pushing on the upside.
So you know, not a whole lot more to add after that point, but the main idea, the main takeaway that he's going to have is to really quickly say this. So these are idealized. You see these cycles, right? That's the ideal sort of thing. It's not to say like, oh, this is what's actually going to happen, or even likely. In bear markets in particular, it fails early on. As I say, you see the high point in the beginning of the cycle and just crashes through the rest of it. So what he's saying here, though, is in line with the ideal. We can see something of a loose pattern play out in this sort of formation. Now, what that can look like, we go over to the stock market, is there's something very significant where we are right now. This area right here is reasonably significant. I don't even have, well, that's a Fibonacci. I mean, I think I had a line here before. It doesn't really matter though. So right here now though, as far as what we were just looking at is that at this period right now, we would see a start of a consolidation. There's look at that. There's 3 Fibonacci lines right here. So to see it starting to consolidate, going sideways, we would say, right over above it, maintaining, you would say, support here, and for it to have a small dip and then a rebound up above, just keeping that in mind. Basically, it's what's going on, and then maybe a month out or something like that from like now, you might see it starting to like, all right, it's getting pretty close to that area. That's basically just the market update. I just want to give you guys. Okay.
Hey, real quick, what is the Fibonacci line used, and what is it trying to actually tell you?
Okay. So there's 2 different kinds. There's the Fibonacci retracement and there's the Fibonacci extension. So the extension is it's extending upwards. How far is that going to extend this way? You can also use it in a bear market context. How far is it extending downwards? So you can use them in those ways. I prefer the retracement because I think it just makes sort of like more pragmatic sense, because for the retracement you're looking at in the bull market context, you're going to be thinking about where's this going to come down to? Where's that going to go? It gives you lines of support. There's areas of resistance and there's areas of support, okay? So these Fibonacci lines, you can notice, right, they're horizontal. So this area here for a retracement here would be looking at areas that we'd be interested in seeing it's coming up to, and then it's going to fail from here. It's going to not be able to, at least so easily and so immediately get above that. Right, that's the typical. It doesn't always manifest that way, but it is a part of the picture of tools that you use in order to figure out what's going on in the stock market. So yeah, I mean it's horizontal levels of resistance and support, and you'll see as well. Right, I already have them up here. Not all your lines of support and resistance are horizontal. Some of them are slanted. Right, now the horizontal, and we'll get into this in a second about volume shelf profiles. The horizontal lines of support resistance, because they can function as both. By the way, also just put this into a clear way that you guys can understand. Let's think of an example. So you're in a bull market, right? And the market's going up, and you can see where there's these areas of, I was just talking about consolidation, right? There's this sideways. In fact, it actually might even help to show the volume shelf profile right now. All right. When you look at the volume shelf profile and get into like, well, how do I get to look at this? What can I, through thinkorswim, there it is, right? This is what it's going to look like. Okay, this is area of a lot of volume. This is shares being right there, consolidating here in this area to show you a significant place of support and resistance. Now, why am I saying it's both? Because if you are in a bull market, right, and it cracks above this level here, let's just say, there's more over here, yeah, that's why there's, all that sort of concentration right there. It cracks above that. It was before. It was resistance, but as soon as it cracked above, right, now there's interest in maintaining this level. It was before that way. It's just sort of how the psychology of money like works out in the stock market. There was interest in maintaining it before as resistance, and now it's cracked above. There's been more interest, even more so for it to crack above, and so now it becomes support. Now there's literally vested interest in maintaining this. Now that's not to say that it can't be violated too, but just keep in mind that's basically how that works. So about horizontal resistance and support, that's why it functions both. When it violates that, it becomes support, right? It can come back down, it breaks support, and now it is again resistance. It was resistance, then support, then resistance again because it broke down again. We would call that also sometimes a false breakout, but it depends on the context. Anyways, so horizontal lines of resistance support are generally speaking going to be more significant than slanted lines. Primarily because Horizontal has the volume shelf profile backing it up. The slanted lines of support resistance are a little bit more arbitrary. You can find still good pieces of evidence to say that this is something that makes sense and matters, insofar as it lines up with the evidence that you're given, right? Repeated points of connection, right? This is just 3. If it's 2 on a slanted line, if it is 2 points of connection, completely arbitrary, doesn't mean shit. If it does it 3 times, however, then you're starting to get the beginnings of evidence there. For here in particular, just because these are significant tops of cycles, so it makes sense that they actually connect like that, just on that logical level. If it's outside that sort of obvious context, then it's going to be less, evidence-based, as you would say. But yeah, questions?
I mean,
Yeah.
couldn't you say it's been a sideways I know we're talking about like the bear market and you're talking about how it meets that resistance level. Once you say it's been at a resistance like for a while, so it really hasn't, the trend hasn't really continued since, I mean, it's hard to point out on your graph, but
You talking about the larger
right in the
bull
middle,
market that we had?
So zoom in.
Zoom in.
Right
Okay.
here, stop. To the left.
To the left.
So, right, warmer. I don't. Do you see what I'm seeing?
Yeah. I see
It's
what
like
you're saying.
it's just been
More right.
more right, warmer,
Keep going.
warmer, very hot. Stop. So like from the bottom of that point to where we are today, isn't that sideways? Like there's really no trend with that.
No, there's a trend. Again, look at the context. You want me to look at a particular point? You don't do that. You look at the context. What's been going on, right? Okay. Again, pieces of evidence here. Again, part of the context. Largest stock market bubble that's like ever existed, or at least tantamount to the one that has been the biggest, right? That was the dot-com bubble, okay? We have market breadth that's crashing. We have COVID that's still going on. We have global economic trouble. There's a war going on with a major world power. Valuations are nuts. You look at the IWM, it's just stupidly obvious. Anyways, so there's lots of points here that would show us to understand why what's going on. Also cycle analysis. Remember he was saying before about the larger cycles cresting together with the smaller ones incur like a larger crash, right? There is a 6-year cycle that's going on that's very major and was there for the dot-com crash and the great financial crisis. It crested with both of those. It's currently cresting in line with smaller ones at the same time. So all those things put together, and also, by the way, yeah, this is still in trend. Even though it's not very significant, it is technically a lower low, right? And this lower high, right, from this major cycle top, right? That's what we would look at. So we are still in a bear market. Make no mistake about it, we're crashing. And historically speaking, the S&P 500 should crash by a total of at least 50%. Cut in half. Your legs are gone. That sort of thing. Yeah, did that answer your question?
I was just saying, like, the point of resistance, we were talking, I don't even know what we were talking about, I was trying to follow along, but I just think the market, you know what, I digress.
It's okay, we're recording it. I'll send the recording out to everyone over the email list. You can look over things again, so don't worry about it. But yeah, that's what I have to say. Okay. So, by the way, just really quickly, actively, because I had this conversation with someone a while ago, actively managed Roth IRAs, right? And in particular Roth IRAs, because I know Forrest might disagree with this one, but I'm gonna give you a reason why. And obviously you have to give, but I'll get into it in a second. When you set up a Roth IRA, for example, and again, in particular, set up your Roth because that's the better one over above traditional. Generally speaking, almost always for very good reasons, it's better. There are 2 options that are put forward to you when you go to a bank and say, hey, let me get a Roth IRA, or you can go through a brokerage account. Webull also has like IRAs. Anyways, they will say, here are your 2 options. Either one, it's not managed by you, and we're just going to set it up for you, and we're going to automate it, we're going to control it. You can put money into it, but we're going to dictate where that money goes to in terms of investment. So you just set it up, you just put money into it, and they handle everything. The other option is actively managed, an actively managed Roth IRA. The conversation I had with that person a while ago was they showed me their Roth IRA, and they had done it with like Fidelity or something, and Fidelity had put her money into their own stock. That's stupid and bad and wrong. That's actually immoral in some senses because it's misleading to say to someone else, like, hey, like, by the way, you should invest in this one and only stock. It's ours, by the way. That's bad. Don't do that one. Make it actively managed. And of course, the question is like, well, wait a second. If it's actively managed, then, Forbes might say like, aren't I going to be more incentivized to like go around and fuck with it? Try not to.
Wait, are you saying actively managed by them or you actively managed?
You're actively managed.
Oh no, I completely agree with that.
Okay,
You
yeah,
should be
all
the
right.
one picking your own stocks or ETF. Don't do robo-advisor. Don't do actively managed by your broker.
Yeah, no, it
Do it
is.
yourself.
Yeah,
It's so easy.
It's bullshit. And again, it's like they put it into SPY or something like that.
And the
One
fees
just-
they charge on active management from
Yeah,
their side,
right,
or
it's
even for
fees
the
too.
robo brokers, they charge a higher fee, and that 1% over 40 years really adds
Yeah.
up.
Oh yeah.
I mean,
compounding
you can
interest.
easily just invest in the SPY,
Yeah.
the 500 index,
Yeah,
and then
and I would
you're-
recommend the leveraged ones over long term. But
Yeah,
at least buy them.
but
It's just
definitely pick
straightforward.
don't
Yeah.
let them do it. Do it
Yeah,
yourself.
no, it's bullshit. Yeah, right. Or go for it.
Can brokerages set like minimum earnings on saying, meaning like we guarantee that you'll earn at least
They can't do
8%.
that. No, that would be illegal if you did that.
To guarantee at
That,
least
that would be completely illegal.
Yeah, because then think about it, they're putting money in for you in your Roth
That's
IRA.
just fraud. It's just flat out fraud.
Yeah.
They're saying that that they can guarantee something on a non-FDIC guaranteed asset.
Yeah,
so
and that as
that
well.
would be fraud.
Yeah.
If
Can't do
an
that.
investor if an asset manager ever tells you that, run the other direction.
Yeah, because that's a
But
shark.
then they do have accounts where it's like, but this account will typically earn, say,
Oh,
20%.
that's the historical average.
yeah, sure.
That's not a future
Yeah,
projection.
yeah.
They can say that, but it's
Yeah.
no guarantee.
Yeah, but you have to understand that's the historical average, not a projection into the future.
Yo, real quick, did you say that you advise leverage stocks over long term?
Yes.
Why?
Because, and we did this before, when you look at the math as it turns out, so the example that we went with as it was mathematically calculated was about like over like the last 100 years or something like that, maybe it was 150 years. The beginning amount was like $100, and throughout all that time, SPY came out to about $500,000. The leveraged version of that was 13 million.
Yeah. So if you look at long term,
Yep.
in terms of the price of it, yes, leverage is better. But if you look at in terms of percentage change, you're gonna fuck yourself if you choose leverage stocks long term. Because if you think about, you go up, let's say 100%, and then you hit the recession and you drop by 80%. 80% of your, how do I say it?
I know what you're
500,000
talking
invested turns into 1 million, and then you lose 80%, even though it's not 100% profit, right? You lose 80%, you just lost.
I totally hear
$800,000.
you. I totally understand where you're coming from. That is not the end of the conversation. That from what I would tell someone in that sort of context. So I put these on the cards too. Mine, I give you resources, the Warren Buffett indicator, the Q ratio, the Shiller P&A. Mind bubbles. Deleverage when we're becoming overvalued in the stock market. You can. There's yield inversions. You can look at like, hey, look, there's recession. You can look at the news, right? We're in a recession, right? You can slowly pull out over time in those particular areas where it's like, okay, like we seem to be like getting into over leveraged areas. When a recession hits, you can pull out more quickly, transition into a SPY, or you can just go to cash. Cash is not trash. Cash is king sometimes. So there are very basic strategies that you can apply to that in order to secure yourself right in that. And also, by the way, as I would say to people, when you're getting close to retirement, like probably 10 years till retirement or something like that, right? Even if like things aren't very overvalued, I would say deleverage. It's time to get out of the leverage position because you want to be able to make sure that you can secure your nest egg, right? So over the long term, those very basic strategies, which is a little bit of intuition building over a couple of years of trading, right? Very likely even, right? You can secure yourself in your funds, in your money, in a way that will be greatly benefited from you doing what you do instead and over and above going with the SPY. Because the returns are just drastically different. Like drastically different.
So just to be clear, you're not saying to invest into a leveraged ETF for a passive 20-year account.
Passive, yes. It is passive. I mean, you think about...
so you're saying if you're not touching your account, you think it's better to invest into a leveraged ETF?
It doesn't even matter. I mean, if you don't engage, you don't look at it, you don't care about it, right? That is a bad idea flatly. That's always going to be a bad idea when you're dealing with money and investments. To just like not have any engagement, that's dumb. That's bad. Don't do that. You have to be engaged on some level, but it can be so little your engagement as to become effectively passive. They talk about this in rental properties, right? There's work involved when you have rental properties, right? There's insurance, right? You have to deal with getting, a property management group if you even want to have one, So there are things that are always going to be involved on some level, but it can be very small to where you would say this is effectively passive, right? There's always going to be things like that. So the point that I'm going to make to you is that yes, you can absolutely, hands down, have a 20-year long investing time period, right? Time span that you're looking at that is effectively passive with minimal interaction, where you're keeping an eye on the news and valuation levels every once in a while, maybe every 3 months. You look for it for 5 seconds. You know what I mean? Effectively, right? So that is pretty damn passive. And yeah, you're gonna benefit like really greatly over and above.
So,
Yeah, Forrest, go for it.
You can finish your thought.
Okay, so just real quick, both Ramesh and Panta both say do not ever put long-term leverage account.
That is
swing
leverage
trading. So leverage would be if you put it into the leveraged SPY.
What is leverage?
Every time the SPY increases by 1%,
Yeah.
the leverage one
Like
increases
context,
by
guys, I'm sorry.
2, 3, 4%, depending on how leveraged it is.
But like, what does that mean?
It's a great question.
So
I don't know.
It's margin. It's what you guys are doing.
So how do I
It's
get
because
access to
of
the leverage?
volatility.
You already are in one.
it's
Okay, so
I
what's
know the
meaning of
argument. It doesn't work out in reality.
We
Listen,
already-
there's a very, very good reason why that is a common rhetoric point that people bring up when they talk about leverage ETFs. You look at, Seeking Alpha, and you look at Investopedia, they're like, don't ever do this, right?
So what's the opposite of what I have?
Their reasoning is wrong and cherry picking. I've literally looked at their examples, badly cherry picked, right?
At the current price.
So-
Oh,
I'm not
so
gonna
just
wait for-
buying
for-
stocks.
It's just direct.
Leverage is
It's when you can
secondary
combine things.
derivative stuff.
Yeah, yeah.
Okay, cool.
All right, you guys
It's
good?
like when it stack.
Okay, all right, let me go ahead and start. Okay, so if you look at Investopedia, you look at Seeking Alpha, you look at these very reputable, you want to say sites. In their arguments against leveraged ETFs, they will cherry pick data. They use hypotheticals that are not realistic. When we look at history itself, when we look back on history, you will see that long-term holding is actually the safest, with minimal interaction. It is the safest. They recommend instead day trading. Oh yeah, go ahead and day trade it. That is asinine and backwards to the furthest extent that you can imagine it. Day trading is already incredibly risky. They say and emphasize the only way and reason you should use these things is in day trading. That is backwards and they're lying to you. That's a red flag right there. And I'll tell you why that's going on. I'll tell you why that's a rhetoric point that they use. Because by the very nature of these leveraged ETFs, okay, your money when you invest in them is not going to the companies, right, that make up the SPY, for example, right? When you buy into the SPY, portions of your money go towards Apple and Google. That means they all rise together because your money is supporting those stocks in their valuations, right? Their stock prices go up, so everyone benefits. But if you put your money into these leveraged ETFs, what happens fundamentally is that you're only betting through derivatives, right? As it is mathematically regulated, 3%, for example, it's a 3%, 3 times leveraged ETF, 3%, 3 times the percent of what the SPY does in a day if you're doing the SPY. If that makes sense, there it is. But, sorry, I just lost my point there for a second. So, yeah. So fundamentally what's going on when you invest in a leveraged ETF is your money's not going towards the companies anymore, right? It is instead going towards, derivatives that are based on those companies. So, based on the SPY, for example. So that is very, very, very bad for these, these organizations that deal very heavily in stock investments, because if everyone looked at these and say, hey, wait a second, I am a long-term holder. Why wouldn't I just go with this? I mean, that's just pretty straightforward. I can look at valuations and keep an eye on things and deleverage when things, make sense to do so. I can do that. That's pretty straightforward. It's easy, honestly. It's a lot easier than you would think. That's bad, because that means that they've just lost money. Because now your money's not going towards the companies, it's not going towards something else that's not the companies. They lose money. That's why that is a point of rhetoric. And again, if you want to believe this, right, if you want to say like, well, is this something that I should really believe? Are you really telling the truth here? Does that make sense? There's one massive, massive point that I can point to that's a massive red flag. They say day trade them. Something just went off. That didn't make sense. These are risky. You want us to day trade them now. That didn't make sense. That did not make sense. And again, look at the examples they say. It's, it's cherry picked. Yeah.
So overall, your strategy essentially is kind of a black swan strategy, right? You're saying you want to, that even in a leveraged account, for those small dips, you're going to ride that out. And because on the long term, those small dips don't really matter because you're going to make your money when the stock rises, and being in that leveraged account will lead to such higher returns. The only point that your mitigation point of keeping an eye on your valuations is avoid the bubbles, avoid the black swans, avoid those major crashes that will bankrupt you.
Yeah.
Ride the small dips, look out for those big ones, and just wait for that fucking rocket ship to take off.
Yeah, exactly. And when you are getting near to your retirement, start deleveraging just for the sake of security, because that.
So it's basically like a black swan type investment strategy where you're looking out for those major crashes.
Yeah, and again, you can, people use that point of a black swan event, and sometimes in the case of oh, you don't know when it's gonna happen. It's
you kind of do.
You can.
I mean, you can tell which swan's black because it's black. There are indicators.
Yeah, you exactly. Yeah, there are indicators. There are the news. You can keep track on what's going on a level of are there major countries? For example, China right now is having a massive real estate market crash, bigger than ours in the Great Financial Crisis. They're just badly over leveraged. I can get into that.
There's a good chance India's going to crash soon too.
Yeah, and then there's England and Japan now too. Oh my God. Yeah, we're just fucked.
If Russia does something that makes India have to, stop buying their oil, if they detonate a nuke, India's economy is going to go to shit.
So you just think because it's so heavily dependent.
Exactly. Yeah.
Because I got a buddy of mine.
Other people have been saying the same shit. I'm just pulling from what I've read.
Yeah, I got a buddy who's from India, and him and his other friend who's also from India were both asking me for financial advice, and they were like, "Why shouldn't we just fully go all
Yeah,
in
I think
on
it's gonna
India
die.
stocks?"
I think it's gonna die.
He was like, "It's literally only gone up forever,
And
even
that's
during recessions." It's
exactly.
only
But
gone up.
if they lose their oil, then
I was like, dude, I don't know anything about India market. I'm sorry, but
Yeah.
best of luck.
Okay, so let's go ahead and move on to the next point here. All right. Okay, so I want to talk about Zacks. Something I want to talk about before. This is just for the sake of giving you guys options here if you wanted to do this. So Zacks is a pretty well-known investment hedge fund management group for stocks, and they have some screeners here that make some really good money. Now, I'll talk about it in a second. It's part of their research wizard. I'll talk about that, and it's well, how do I get this? What are you talking about? I'll get into that in a second here. I just want to show you really quickly the numbers that they've been getting. If you don't like leverage ETFs, that sort of thing. Okay, so let's see. I think it was this one. Let's see here. Yeah, that's pretty good. Filtered. Big money. There it is. Okay. So in the beginning here, they show big money, Zacks, their particular picks of stocks and parameters about how they filter this as part of the nature of a screener, right? You're looking for particular things, price sales ratio, right? Stuff like that. Anyways, it doesn't really matter so much like that. But look at what they've done. From 2000, and mind you, that's actually pretty impressive because 2000 was the start of the .com crash, which was a massive blowout. The NASDAQ fell by 83%. That's nuts. These guys, however, from then to 2021, have averaged 54.5%. Now, that's not CAGR, right? Compounding annual growth rate, which is all right, any given year, how much did it go up by, right? That's CAGR. How much could you expect your money to go up by? Average annual return is this year it grew by this much. That year it grew by that much. All right, put them together and divide it by 2. Right? 1, 2, put it together, divide by 2. That's average. Anyways. But as the math works out, they're really close anyway. So just wanted to say. 54.5%. Now again, some of these leveraged ETFs though have grown by 50, 55, and 60. Even one of them did 70. CAGR, which is going to be a little bit better than the average annual return. In terms of we're looking at 54.5. CAGR would probably be 56, 57 or something like that. Anyways, but this is the thing that you can do. This is something that they have, and it's not just big money Zacks. The one above it did 50. There's one below, I believe, small cap. Yep, there it is. That did 50. Here it is. So this is pretty good. They went through both the Great Financial Crisis and the .com crash, and they did pretty damn fucking well for themselves. So there's an option for you guys. Now, how do you get this? Okay. Zacks, here it is, right? Zacksrw.com, free trial. You know, it'll have it up there. You know, just go to that website, free trial. There it is. Bam, here you're on this page. Okay. All you need is your name, your phone number, email address. They'll send you an email with like the instructions of like how do I set this up. They even have a number in case you get confused somehow, and then there it is. And the email address, by the way, very important to say here, if it's a part of a 2-week trial. Let's say you wanted to keep doing this just ad infinitum, right? Email address. There is a really good website called Gorilla Mail, like gorilla the animal, mail.com. They will just make up an email address for you. You can go through their platform. Here, I probably find it, to be honest. Let's see if I know how to spell gorilla. That's, yeah, okay. Oops. Huh. Weird.
I found it.
Huh?
I found it.
You found it? What did I do?
I don't know. Now you're just misspelling.
Oh my god.
Now you're just spelling terribly.
It's called Gorilla Mail. Anyways, Forrest found it. There you go. Alright, doesn't matter. Okay, so so yeah, every single 2 weeks that it ends, put another one in, bam, there you go. You don't have to go like, you know, just for ease or whatever. You know,
Gorilla Mail saying they create your email for 60 minutes, basically, so you only need it
It
just to
sends
sign
it
up
to-
and then you're good.
Yeah, it sends it to you immediately,
Nice.
and they have their own platform you put onto your desktop there. You click on it, and then they have the whole thing
That's awesome.
platform. It's just being able to get like the code to be able to access their platform effectively. Anyways, it's all there. So there's that. Zacks. Slim ribbon and volume shell profile. Okay, so here's another tool for you guys. Now this is through thinkorswim. It's a really, really good strategy, or tool I should say. Let's
How
see.
far down the
Oh my
arrows?
gosh. Okay. So here's what it looks like on the right hand side here. It shows when things are on basis of momentum. We talked about momentum before. It's the velocity of money in and out of the market. Point is, though, I mean, he says it all right there on this video of his. I'll just give you guys the rundown of this one. Go to askslim.com. Free resources. You click on that. It is free. You go down to Slim Ribbon. It's right there. Slim Ribbon. Here it is. He has a whole video explaining everything, and then about how to, and the instructions about how to get this onto your desktop. Goes to the thinkorswim platform, and that is one thing that can really help you on that thinkorswim platform. The other thing is the volume shell profile that they have set up. And if you're trying to figure out like, well, you know, how do I use this? How do I access this? You can look it up online. It's really straightforward. I promise you guys. So they have the instructions there about how to set up that Slim Ribbon part. The volume shell profile, that's what that looks like. We talked about this before, right? There's a concentrated amount of, you would say volume, right, of shares, numbers of shares that are built up here. Access, support, and resistance. You can use those two together. Again, that video explains everything on the other page here. Explains everything about like how does that thing work. Anyways, so there's that. Just want to give you guys that quick resource. And then here's another one. Forex Factory. This is one that I use for news. forexfactory.com. Right? So you time up there to be able to make sure it's synced up together. It isn't right now. It says 5:53 and it's like 3:48. But you know, there it is, and it gives you all the news of multiple different countries, and of course as well the U.S. right here. We've got some interesting news here today. At 10 a.m. sort of came through. Pending home sales minus 10%. That's bad. Yeah. By the way, the real estate market's like crashing. So just like FYI, massive. This is why they're calling it the everything bubble. Crypto, real estate, and stocks and bonds are all have been in a bubble and are all currently crashing. That's just something you can look at. Home valuations, I would recommend the website. There it is. Yeah. Longtermtrends.net. You can put this into Google, right? Case Schiller. Oh no, get out of here. I don't want you. I don't subscribe. Get out of here. Case Schiller home price to CPI ratio. There's the housing bubble. There we are. A bigger bubble than that.
Man.
Yeah, it's massive. That's why you call it. It's
Do we have a minute to touch on that? Just since you
Go for
have
it.
a lot of
Yeah,
research, you've got a lot of real estate information, so that's sort of why I would like to touch on that with you. So obviously the Fed has increased interest rates. 30-year mortgages just hit 6%, I believe it was.
Yeah,
it might have
makes
even been,
sense.
I believe it was 6% like 2 days ago.
Yeah.
When are you looking to buy real estate?
So historically,
When are you, I'm asking, when are you personally
Yes.
thinking?
Yes.
Yeah.
So historically speaking, I'm doing it at the same time because it works out in my 5-year plan. Is it took us 5 years to go from the very top to the very bottom of the housing market bubble. Again, you can look at valuations. You can look at the mean here. I'm pretty sure they have it here. Okay, they might not. But that's okay though. Again, you can look over like the long term. Be like, here, I wonder what the average is. You know. So any 0.6 even, right? That was the very bottom of the great financial crisis. So around this area right here is probably what I would recommend looking for. And it took us 5 years to go from the very top to the very bottom. So that means that right now, 2027 should be the bottom that we can look for, again, based on history, and again, working together with valuations. If it's been like 5 years and we're still at like 0.8 or something like that, you know?
Well, that would also have an impact too, like what they're going to set interest rates to. You would assume that as that housing market bottoms out, they're going to say, "Oh shit, we did a mistake. We got to switch courses and lower the interest rate now."
Yeah.
So like that's sort of what you're.
Yeah, no, sure. I mean, that's going to be definitely part of the picture.
Or how much do you worry about interest rate too?
Reasonably, because we Japan, China is looking at engaging in quantitative easing, and also England. These are some of the largest economies in the world. They're like all top 5. I'm pretty sure Japan might be 6. They're like top 5 basically. If 3 of these people are saying, "Hey, we're going to go ahead and do quantitative easing, fuck everyone else basically about their inflation problems. We're going to go ahead and do this." We are so globalized. This is going to cause problems for us trying to fight inflation. That will drag out the fight. So, yeah, we'll probably have interest rates being high for a while, unfortunately. But hey, it makes opportunity. I'm sure you guys might have even heard it, like, millionaires are made through crashes, that sort of time, right? That's using very bullshit, manipulative way, unfortunately, about like, hey, the market's like crashing or it's correcting. Now's a great time to invest because that's how millionaires are made. It's like, that's just like bastardized version of like the actual truth.
I mean, isn't it though?
What's that?
Isn't it though?
Sure, not the way that they use it though.
If we see a 50% collapse of the S&P, it's like, I mean, it's like going to the thrift store.
Yeah.
So, just gonna...
No, I mean, like, you're not wrong, yeah, but, it's unfortunate that they're using that sort of, the way that I've seen it used is like, hey, now is the time to buy or
You're talking about like
start.
BlackRock and stuff like that,
Huh?
like the BlackRock, like permanent capital going in and trying to make the renter class thing.
Well, go ahead and elaborate on that. What do you
Well,
mean?
like you're saying that that there's a right way to buy assets at a discount, there's a wrong way to buy assets at a discount.
Yeah, sure.
BlackRock's going in right now, buying up tons of these discounted homes, discounted assets at pennies on the dollar or
Sure.
50 cents on the dollar, whatever it is. So, but what their plan is for it is to then turn us all into renters. So, like, to me, that's a bad way to buy on the downswing. But like, there is a way to morally purchase distressed companies and not do it. Is that your point, or was I missing that?
So my point is, we can get into what you were talking about in a second because there's some truth to what you were saying, but I had to clarify. So what I was saying was that the rhetoric that I've seen of people saying like, there's this great opportunity that's happening like right now. You've just seen it so many times from so many different places. It's a great time right now. The opportunity is right around the corner. Millionaires are made through corrections and crashes and blah blah blah. That rhetoric is used in the context of like at least, if not explicitly, subtly saying to people, "Hey, you should be buying like right now."
Oh,
yeah.
Okay. I get you more now.
Yeah. Right. So so there's that. Now, as far as what you were saying, yes, there was a lot of these big, large companies that are going in and buying real estate, and I think that certainly has. I would very seriously believe that it has contributed to this massive bubble that we've been looking at. And are they still doing it like right now? Yeah, probably, because there's going to be some very small select markets around the country where it's like, oh, there it is. We can grab that one, right?
And they can pay cash too, so they don't care about the interest rate. But then, as you just said, the market's diving, so the prices are coming down.
Yeah. Well, so this is part of what we would want to how we would want to think about this, right? So on one hand, they can keep these homes, they can rent them out forever, and on the other hand, right, it's about control of the market. They've been buying as it's been going up, and now that it's topping out and peaking, looking like it's starting to crash, right? What are they gonna do? They're going to control when and how that happens. We're not in control, right? The real estate market is very liquid and hard to make quick sales, right? So the whole point that they have as an ability of theirs with these large collections of homes is to start it when it's convenient for them. Right now they're collecting rent, but also there's all these problems on a larger basis. So in the very least, you can put it like this, you can understand it like this. They're going to drag it out for as long as they can because they're collecting rent. And as soon as it's like not viable anymore for a multitude of reasons, whether it's global economics, whether it's interest rates, whether it's home builders coming back in, they will start dumping on the market and selling at the very top while everyone else is scrambling around trying to be able to, figure out what the fuck to do, or hey, I'm still trying to buy a home. Interest rates are high, but when do they go higher? FOMO. So yeah, stuff like that. Anyways though, so there's that. Okay. And then one last little tidbit here, heikin ashi. We talked about this before, but it's just something to note here. If I can go on here, not that one. Wait, yes, it's in line style. Anyways, okay. There's a spy, heikin ashi. There's a video that we did on it in a past video. You guys can look through that. You can find the video or just research around online for yourselves about how heikin ashi works. But just sort of as a way of looking at it, you can see, how momentum plays through on this tool as well. Overwhelmingly green. There's a lot of red. You can see these green upturns. They're pretty damn consistent. We're in right now a pretty consistent one as well. It's not to say it can't change, but when you can see it start changing though. That's something to keep in mind. And yeah, that's basically all I want to say. All right, so there's that one. Okay. All right, and now a video. Ooh, all right, let's relax for God's sake. This guy, here we go. Not this guy.
Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to be talking about how you should never tell a car dealer that you are paying cash, especially during the sales process and especially during the negotiation process. If you've saved up money to buy a car with cash, congratulations, that is a good thing. However, most people think that this is a positive thing and it's a negotiating chip in their favor when in fact it's probably hurting them, making them pay more for the cost of the car. So dealerships in today's business model are not incentivized in any way for you to pay cash for their cars, and it actually may result in you paying more for the car. So in this video, we're going to talk about how the modern car dealership business model works. We're going to talk about how to actually buy with cash from a car dealer. And finally, I'm going to talk to you about how I personally buy cars with cash and other options outside of the dealership model. Stay tuned. Okay, so let's try to better understand how a modern car dealership business model actually works and operates. So new car sales account for 58% of sales at a dealership. So when most people think of car dealerships, they think that they make a majority of their money on the sale or the price of the car, which couldn't be further from the truth. Although new car sales make up 58% of sales, it only accounts for 26% of gross profit. The reason for that is because pricing is transparent now. People have phones, they have apps, they have the internet. You can find out what the price of a car is in roughly 5 to 10 minutes if you just do some preliminary research. It's not that hard. So car dealers need to make money elsewhere. So what do? They make a majority of their profits from F&I, accessories, service, fees, and parts. These are the major profit centers of a dealership, okay? So the car, think of it literally as a vehicle, no pun intended. Well, pun intended is the whole point of the video. The car is simply a vehicle to get you into high margin finance and insurance products. That's what F&I stands for. Those are the guys in the back that do your paperwork. So F&I is simply where they sell you gap insurance, wheel insurance, extended warranties, protection packages, etc., etc. And the funny thing is that 55% of these extended warranties, according to extensive research, shows that these extended warranties are never used. So you're paying for a product that you end up not utilizing. So if I was a casino and I had a 5% house edge right here at 55%, I would be salivating at those numbers. So the next slide, now that you understand how the business model works and where they make their money from, is going to actually teach you how to go through the sales process and how to actually buy a car with cash. Okay, so this is the part that you've all been waiting for. So how to buy a car with cash from a dealership. So there's only 4 factors that go into a car deal, okay? You have the price of the car that you're interested in, you have your trade-in, if you're going to trade in a car, if you're not, then you can get rid of that factor. You have a down payment, so this is the money that you're putting down. In this case, if you're a cash buyer, that is 100% down. If you're putting down less, you're gonna get some payments thrown at you, okay? This is pretty much what every car sale boils down to, these 4 factors. So let me take you through a very quick example of the sales process. We've all been through it. Mr. or Mrs. Car Buyer, you come to the dealership, you're greeted by a salesman. Hey, I'm Marco with No Lube Chevrolet, where we service you with no lube. How can I help you today? I qualify you, I put you on a car, you go on a test drive, you come back from the test drive. Hey, Mr. and Mrs. Car Buyer, how'd you like that new car smell? You know, would you like some coffee or tea? We'll take you inside, look at some numbers. How does that sound? And we go through the sales process, and this is where the negotiation starts. Most people that are cash buyers shoot themselves in the foot at this step right here. Do not tell them you're paying cash. This is where you kill all of your negotiation power, and I'll explain why. So dealerships are incentivized. Remember, the new business model, where does 74% of their revenue come from outside of the sale of the car? It's from F&I and other things, service packages, accessories, etc., etc. The way that dealerships make money is by literally becoming the bank. So they can either be their own lender, or they can shop out your profile and your credit score to all the different lenders in their network, and they can probably get you a pretty good score. However, this is where they make money, and this is where you have more room, and number 1, to negotiate on price. You lead them to believe that you are financing with them, okay? Just pretend that you're not a cash buyer, you're putting down 10, 15%, I don't know, make up a number. So once you do that, the dealership knows that they're either going to make a flat, which is basically a commission. So when Mr. and Mrs. Car Buyer, end up taking a loan with dealership's Bank X is going to pay the dealership a flat fee or a commission. Or the other way that dealerships make money through financing is through loans, is through points or financial reserve. So basically all this is that you qualify for a buy rate. Say you're an 800 credit score, the loan is going to be 4%, right? That's the buy rate. The dealership will bake in numbers, they'll bake in 2 extra percent called the sell rate. And that's where they make the arbitrage. That's where they make the 2% spread. So for quick math, if you took out a $20,000 loan, financed at 60 months at 4%, and they give it to you at 6%, that 2% difference is worth $1,033 over the course of that loan in spread. So now you can see where the dealership would be more willing to negotiate on price is because they're making money here on the payments. Make sense? So now you're probably asking yourself, well, Marco, I don't want a loan. What does all this lead to? I thought the point of this was to buy the car with cash. Yes, so when you go into the back office in F&I, okay, where they sell you the gap insurance, the wheel insurance, all that good stuff, that's actually where you find the sheet and you basically break down every single one of the costs, okay? And we'll get into that right here. Okay, so this is where the rubber meets the road in the video. This is what you're going to do in the back office. So you are taking out a loan from either the dealer themselves, someone part of their network, or actually the manufacturer's financing arm. So like Lexus Financial, GM Financial, etc., etc. The reason you are doing this, as mentioned earlier in the video, is because you're going to beat them up on price. Once you finish the sales negotiation on the floor with the salesman, you're going to be in the back office and they're going to present to you your final numbers, okay? So typically what this looks like is you're going to see retail price. This car was $32,997. Well, you got us down to the sales price, which is now $30,000. You're going to break out your local taxes. In this case, I just assumed 10%. That's high, but just assume that for easy numbers. Then you have like doc fee 1, government fee 2, some BS fees that they make up, which I'll explain to you in a second here what to do. You have gap, which they're going to build into this, gap insurance, and then accessories and service packages, things like that. I just ran out of room on the whiteboard. So you're going to come to a total number of whatever that is, 5 figures minus your down payment, and that's going to be the amount financed. Now this is where you actually want to still continue the negotiation process, and don't be afraid to walk away if they don't meet this, okay? This is going to save you money, so pay attention. So since you're taking out the loan, first and foremost, you need to understand if this loan has a early prepayment penalty. If it does, then what I'm explaining is not going to work. It's not worth the effort. If it doesn't, which most loans shouldn't have an early prepayment penalty, then you just save yourself a bunch of money, and you can send me a commission check in the mail if you want to. Just kidding, not really. All right, so what happens is once they break all this down, you're gonna say, oh, doc fee, $500, no thanks, I'm crossing that out. Government BS fee, no thanks, I'm crossing that out. Gap, I don't need it. I'm just saying for this example, if you want Gap, use it, whatever, I don't care. Accessories, I don't need it unless you want it. Then you have them redo the price. They're gonna say, oh, this doc fee, that's state mandated. If I charge you X, I have to charge everyone else X, otherwise I'll lose my license, blah, 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 blah. Well, guess what? For all the big brain people in the comments that are gonna leave a negative comment, this is just a negotiation chip, okay? You don't have to knock this out. All you do is you take this $500 and you take it off the price of the car. You say, okay, I'll pay the $500 fee if you charge me $29.5 for the car. Does that make sense? So you're just buying yourself more negotiation power. And if they say, no, I can't do that, you know what you say? Thanks, Mr. F&I, have a great day. And you walk away with a smile on your face and you drive off into the sunset. I'm just kidding. But anyway, you're buying yourself more negotiation power. So you're still going to end up paying for the sales price of the car. You're still going to pay the same tax that you would have paid. You may buy yourself some negotiation power with these BS fees. You're not going to pay this stuff. You have them redo the total. You put down whatever you said you're going to put down, and this is the point of the video. You get your payoff amount from the lender, let's call it 30 days later or 45 days later. You say, hey, what's my payoff amount? It should simply just be these numbers, sales price, tax, whatever the amount you financed minus your down payment, and you send them a check, cash. You just paid cash for the car while still getting all the benefits of the sales price negotiation. Does this make sense? Okay, so now that I saved you a bunch of money, this is how I've been buying cars my entire life. My parents are immigrants, we don't buy new cars, I've never bought a new car, probably never will. I don't lease cars, I own a business, maybe leasing makes sense to save me some money as a write-off. I don't care, I don't even play those games. I buy cars with cash from private parties, okay? What's a private party? It's a human being just like me and you. Are there shady people that exist? Yes. Are there good people that exist? Yes. Are there rich people who maintain the crap out of the car, made it pristine and serviced it at every single service interval, took the depreciation hit, the maintenance hit, and now they're selling it to you for cheap with no fees that a dealer would charge you? Yes, those people exist too, and that's how I buy cars. I buy cars off of forums. I buy cars off of Craigslist. I buy cars off of private parties who have taken who have well maintained the car and have all the service documents and everything. And I'm also mechanically inclined, so that helps too. So is my dad. So my point is, I've broke even or made money on most of the cars that I've owned. I've only lost money on a couple cars that I've owned. I buy cars that have high demand, low supply, typically enthusiast cars. I drive them for a little bit, sell them, make money or break even, okay? This is why I've never had a car payment my entire life. So let me elaborate on these two very quickly, because I know people in the comments are, oh, I don't have a mechanic, I'm not mechanically savvy, I'm gonna get taken advantage of. Just use some common sense, dude. If you're pulling up to a beautiful residential development, the guy lives in a $500,000 house or a McMansion or whatever you wanna call it, he probably took good care of the car, okay? And you check it out and inspect it. Just use common sense. So what I do is I go to forums. If I'm looking at a Volkswagen Touareg, which is not made anymore, I'll go to Volkswagen Touareg forums. If I'm looking at a Porsche Cayenne diesel 6-speed manual, which they're not making anymore, I'm going to go to a Porsche forums, Rennlist. I may go to Craigslist. I may set up an automatic search so when certain words meet my criteria, I get emailed and you can see if the car is in good shape or not. So this part of the video probably resonates with maybe 5% of the people watching the video, but this is the best way to buy a car. You avoid all the dealership fees, you avoid all the sleazy salesmen, you avoid all the headache of going through the dealership process. You're simply dealing with another human being. If you have a good judge of character, you know what to look for.
Alright, and that's what's the video. I'll go ahead and have the link for this video in the description of the video. Our video, my video. And I believe at that point, oh yeah, okay, so and then just one last bit and then we're done. Student loan forgiveness, it is now open. You will be automatically enrolled for forgiveness. I think that happens like in November, something like that. I think it might be like, I don't know, somewhere in November that automatically happens, or you can do it earlier on. I did that myself. I got an email for it. I was like, yeah, sure, I might as well. Probably wasted 2 minutes of my time, but who cares? So there's that. And all right, that's it. All right, yeah, thank you. Thank you, my Goonies, for participating in caring and getting rich. Goodbye.